One of Canada's largest railways just saw a decrease in revenues, but it raised its dividend. And Netflix is up sharply this morning on its latest earnings report. The Bank of Canada's rate decision is what everyone was expecting, and Canada Post is selling assets to try and survive. Today is Wednesday, January 24th, 2024. Let's get started with today's news. I want to go through a few earnings reports this morning, and we'll start with one of Canada's largest railways, CNR. They reported Q4 earnings, and revenues came in at $4.47 billion. That's a year-over-year decrease of $71 million, or 2%. Operating income was $1.18 billion. That is a decrease of $94 million, or 5%. Net income was $2.1 billion, a 50% increase of $710 million. And adjusted net income was $1.3 billion, a decrease of $115 million, or 8%. Diluted earnings per share, they were $3.29, an increase of 57%. Adjusted diluted EPS was $2.02, a decrease of 4%. The company also declared a 7% increase to its 2024 cash dividend. That will be effective the first quarter of 2024. This is now the 28th consecutive year the company has raised its dividend. As far as guidance is concerned, in 2024, CN expects to deliver an adjusted EPS growth of approximately 10%, and they expect to invest $3.5 billion in its capital program, net of amounts that are reimbursed by customers. CN also expects a return on invested capital to be within the targeted range of 15 to 17%. Netflix shares, they were up about 12.5 or 13% this morning after they reported their Q4 earnings. Earnings came in at $2.11 per diluted share. That's up from 12 cents a share a year earlier. It's a good gain, but it was below the analysts' expectations of $2.22. Revenue in the quarter, that was $8.83 billion, up from $7.85 billion a year ago. The expectations there were $8.71 billion. The company says that it expects Q1 diluted earnings per share of $4.49 on revenue of $9.24 billion. That's above expectations of $4.10 per share. There was stronger than anticipated membership growth in the quarter, and the company says that earnings were buoyed by continuing with its password sharing crackdown that they started, I guess, last year at one point. They also said price changes and a strong content slate contributed to their earnings. They do project, though, that net subscriber additions are going to be down sequentially, and that will reflect seasonality and some likely pull forward. They put in their report, net ads are expected to be higher than last year's 1.8 million. Procter & Gamble reported their Q2 core earnings, $1.84 per diluted share. That's up from $1.59 a year earlier. Expectations were $1.70. Net sales for the quarter were $21.44 billion compared with $20.77 billion a year earlier, slightly under the expected $21.5 billion. As for guidance, P&G raised its fiscal 2024 core earnings estimate to between $6.37 and $6.43 per share. They also maintained their sales growth outlook of 2 to 4%. Now, that said, they cut their annual profit forecast to reflect a write-down in the value of its Gillette business. Johnson & Johnson reported Q4 adjusted earnings. They came in at $2.29 per diluted share, up from $2.05 a year earlier, pretty much on line with expectations of $2.28 a share. Revenue from the quarter was $21.4 billion, up from $19.94 billion a year ago. That also beat expectations of $21.02 billion. The company here says that it expects full year 2024 adjusted EPS to be $10.55 to $10.75. Revenue for the full year is expected to be between $88.2 billion and $89 billion. That is slightly ahead of expectations of $87.95 billion. They did experience double-digit growth in its medtech business this past quarter. Revenue in the division climbed 13%, came in at $7.67 billion. They cited gains in electrophysiology products, also orthopedics, surgery, and vision. And J&J anticipates adjusted earnings per share in 2024 to be in the range of $10.55 to $10.75. They also reiterated their per-share adjusted operational earnings outlook that they issued in December for the ongoing year, and it also kept its operational sales guidance of 5 to 6% unchanged from its prior forecast. Now, Tesla will be reporting after-market hours today. By the time you're watching this, it will be aftermarket. By the time I'm filming this, it is during the day, so those numbers aren't out yet. I will be sure to talk about the Tesla earnings report in an upcoming video. As pretty much everyone across the board had expected, the Bank of Canada left its prime lending rate untouched this morning at 5%, and this is now the fourth consecutive decision to keep the lending rate even at that 5% level. It's also a continuation now of having these borrowing costs continue at this 22-year high. There was a bit of news. The bank explicitly stated during the production here that they don't expect they will need to increase rates again so long as the economic conditions continue to evolve in line with its forecasts. At a news conference, Bank Governor Tiff Macklem, he summarized the committee's deliberations and said that the discussion on future policy is shifting. So I'm going to take that as a pretty clear signal that the bank is getting more comfortable with saying that the next move will in fact be down. But as always, that can change if the data steer them in a different direction. In his statement, Macklem said, "If the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain the rate at 5%. The bank did note this morning that it does remain concerned about risks of the outlook of inflation, and in particular, it singled out the underlying price growth after we saw an unexpected increase in the preferred core inflation gauges during the Statistics Canada report in December. At this point, the bank expects headline inflation to remain near 3% mark for the first half of the year. Then the expectations are that it's going to ease back to the 2% rate in 2025. I know that everyone can't sit there and watch every one of our YouTube videos, but we do have you covered. You can listen to all of our YouTube videos in podcast format. So whether you're driving, maybe you're out for a walk or a run, maybe you're just trying to fall asleep to some stimulating economic news, every video that we post on YouTube also has a podcast version. So go ahead and look us up on Apple Podcasts, Google Podcasts, or Spotify. Or if reading is your thing, subscribe to our weekly newsletter, The Pulse. It's growing every week, so join the crowd and subscribe for delivery directly to your inbox. Canada Post lost $548 million, so more than $500 million in 2022. Now, in just the third quarter of 2023 alone, they recorded a loss of $290 million. In the first 3 quarters of 2023 now, the company has lost $516 million, so ahead of last year's pace. That obviously is not a good thing. In order to revamp the financial condition there, Canada Post is selling its IT and logistics departments. They announced that they would be selling Innova Post to Deloitte Canada, and this division employs around 750 people. It's reported that the majority of these people will be able to work with new employment offered by Deloitte. But last week, they also announced that they were selling its third-party logistics business, SCI Group, to Metro Supply Chain. This group has around 3,000 employees, and the future of its workers are a little bit less certain. Media relations spokesperson Lisa Liu, she directed reporters when asked about questions about the employees. She said that they should talk to Metro Supply. Canada Post spokesperson Yannick Cormier wrote, "Canada Post has been executing a comprehensive transformation plan focused on serving the changing need of Canadians and Canadian businesses. The plan positions the company for growth in Canada's e-commerce market while delivering on its core mandate of providing reliable delivery of mail, packages, and parcels to every Canadian address." Ian Lee, he's a business professor at Carleton University. He's been researching Canada Post, and he says the future of Canada Post is not in pretending that they can deliver letter mail when it's collapsing by 6 to 8% per year by number of pieces. He says that in order to survive, they're really going to have to be to make more aggressive moves into e-commerce and capitalize on that continually growing online shopping trend. The future is in reinventing themselves as a partner of e-commerce companies and trying to get back that business that they gave up and lost competitively to the Amazons of the world. One of the challenges that Canada Post has in order to compete with its competitors is the cost structure of the business. It's not even closely competitive to independent delivery companies. And I know where I live, I often see deliveries being made by vans or even cars where people just pull into your driveway. So they bypass the big Purelators, FedExes, and that type of competitor. I will put a link here for our Pulse newsletter, which we publish every weekend. I will also put a link to our Investing Academy. Check us out there. Thank you for watching. We'll see you in the next video.